Good afternoon, and thank you very much for inviting me to be here. And thanks to Santiago for the introduction. It's a little bit embarrassing actually listening to it, because when he said I've got over 30 years of experience, I'm still only 42, so I don't really know how that could possibly have happened. Anyway, there's a few things. I guess it's been a very interesting day for me for a number of reasons. Learning about smart grids and smart meters and all these wonderful things that we've listened to this afternoon, and how to get my kids to turn the lights off at home so we don't have huge electricity bills all the time is one of the things that I've learned. What I was planning to talk about was creating a sustainable energy mix challenges from an upstream E&P perspective. As Santiago said, I did my part-time MBA here, graduated in 1996, and it's the first time I've been back to the school actually for about 10 years, which is rather sad, but it's been, it was a great experience. I've put this slide in here really, as you'll see on the next slide. I've worked for a number of organisations, and I should point out that all these views that I put across in this presentation are mine and nothing to do with any of the organisations that I've worked for in the past. Santiago said that because there'll be a lot of MBA students here and other students from the school, probably be interesting just to give a little bit of a career overview, and also how the MBA fitted in and has been useful to me in my career. So, as he mentioned, I started out as a technical interpretation geophysicist with Texaco here in the UK. And that was an interesting start. But I moved to Exxon quite early on in my career to live in Houston in Texas, which of course is the capital of the oil industry, at least in terms of the Western OECD countries. To work on the Far East, and I also did a little bit of work in North America. And I was lucky enough to be involved in discovery of a lot of gas in Thailand. As part of my early career. So that was a great experience when you have a big organisation like Exxon and a very small project team, and you find some gas and everybody wants to spend money on what you want to do. So I was rather spoiled, I think, from that perspective. I got headhunted, and I actually joined a British company then and moved to Madrid. So I learned to speak a bit of Spanish. Unfortunately, after a couple of years in Madrid, they moved me back to Aberdeen, which was slightly less attractive. It was cold. I remember leaving Madrid, and I think it was about 20 degrees when I left Madrid. And I got back to Aberdeen, and there was about a foot of snow, and it was minus 6 degrees. And I thought, what have I done? Anyway, it was a very interesting time. I moved from frontier exploration, I suppose, through into exploration, development, and production in the North Sea with BP. Up in Aberdeen, and then I moved back down to London, and I was put into corporate planning and control, which was the first time I'd ever really been exposed to all these other esoteric disciplines like economics and finance and balance sheets and profit and loss accounts and things like that. And I was working with a bunch of accountants and finance people and long-term planners, and we were trying to pull together the whole corporate plan for the BP organisation. And so it was a great place to get a helicopter overview of what was happening in the organisation, but quite a steep learning curve for somebody like me who was used to looking at seismic sections and well logs and things like that. And while I was in the corporate planning and control group, there was a chap called Bob Horton, who was the chairman of BP at the time, who sadly died a few weeks ago. But he was intent on completely reorganising and restructuring BP, which of course at the time was Britain's biggest company. So that was a very interesting sort of exposure to how to change the culture of a company. And perhaps how not to do it, actually, because there was an awful lot of things that I think he had the right idea, but he was perhaps approaching it in a way that wasn't necessarily appreciated by the people in the organisation. I then moved into, I had a brief stint actually looking after exploration in Cuba, if you can believe it, which I had to keep very quiet about because BP wasn't allowed to be seen to be operating in a place like Cuba. So I had to go in very, it was a little bit like working for MI6 actually, I think. And after that, I got involved in selling some of the assets, and I moved into the mergers and acquisitions group, and I largely focused on Northwest Europe. And it was at that time that I decided perhaps it was about time I actually learned something about what I was doing. So I started the MBA at London Business School, which was at that time, it was a 2.5-year programme. And it used to require a week every term and every other Friday in the school. So that was fine when I was working in mergers and acquisitions because the BP office was in Moorgate, so in the city. But about halfway through the MBA, BP, as big organisations do, suddenly decided to move me to Abu Dhabi as Deputy General Manager. So that was fine, except for the fact that to get back, I had to fly back overnight on the Thursday to come straight into the school on the Friday and then sit through a whole lot of lectures and case studies and things like that. So I guess the first thing the MBA was teaching me was how to read case studies very quickly and how to do it while you're half asleep. So that was an interesting challenge. So having finished the MBA, unfortunately Abu Dhabi didn't really fit with what I wanted to do from a family perspective. So I was approached about a job as Technical Director of Powergen North Sea, which was a wholly owned subsidiary but set up as a separate company effectively with its own budgeting process and non-executive directors from outside. And that was my first board level sort of role. And the interesting thing was, from the MBA perspective, I thought I'll never have to worry about marketing or any of these sort of things because I work in the upstream oil industry and marketing doesn't really bother me. But Powergen was my first exposure to areas where customer-facing business issues came to the fore. And it was quite interesting going to some of the focus groups and listening to people talking about what Powergen meant to them. And there was a whole advertising campaign, which some of you may remember, which was all focused about weather forecasting. And the interesting thing was the power of the brand was great. People could always remember what Powergen, or the name Powergen. What they couldn't remember was what they actually did. And the focus groups kept coming back and saying, oh, don't they make the weather? Or something like that. So it was a fascinating time. The strategic thrust was to try and manage some of the exposures that we've heard about in the talks previously. Powergen was privatised in the middle of a liberalisation of the gas markets, and had committed to building a series of CCGT power stations. But it was exposed to very high gas prices at the time. So the idea of Powergen North Sea was for us to access new sources of gas, primarily from the E&P function, which would reduce the overall cost of gas to put into the CCGTs. But the other thing that was quite interesting was just learning a little bit about the issues of coal and power itself, because although I was in the upstream division, we used to get involved in the overall sort of management of the business. And Powergen had invested £1 billion in a flue gas desulfurisation unit to put on the back of one of the Midlands power stations. And that was great. It was cleaning up some of the emissions and everybody was focused on the environment. And we went up to look at all of this stuff at work. Problem was that the building industry had gone into a downturn at the time, and the output from the flue gas desulfurisation was usually used by plasterboard manufacturers, gypsum. And there was a mountain, literally, in a huge warehouse of all of this gypsum, which couldn't be shifted because none of the building industry was taking it. And it just brought home to me that, sometimes you get unintended consequences. You think you're doing the right thing, and I'm sure FGD on the back of coal-fired power stations helps. But what do you do with some of the other byproducts? Powergen decided they wanted to move into America, and so the business was actually sold. So I was largely involved in actually selling it, and I went across with the business to Centrica. So I'd gone from a power generator trying to buy gas to feed into its portfolio to a gas business that was actually looking to build power generation capacity. So sort of two ends of the spectrum. And I went across there effectively to run the North Sea business and also to build it. And in fact, interestingly now, Centrica just announced its results. And the bit of the business that I was responsible for has now grown since I left, and is now the biggest bit of Centrica, which is quite interesting. So the business has sort of rebalanced itself from being much more of a, I mean, it's still a very customer-focused business, but the profitability is largely driven now by the upstream part of it. Whilst I was there, again, got involved in marketing, and there were all sorts of good learning experiences for taking care of the essentials and how strap lines and all these things work. All this stuff that when I was doing the MBA used to sort of, I have to say, sort of go over my head because marketing was never really something that I focused on. And it was an interesting time to be in a utility like that. But you could see the problems that we've talked about, and we heard today this afternoon from Brendan, and the issues of how utilities deal with some of the things and how innovative or otherwise they are. And I think there is actually a lot of innovation in the utilities, but sometimes it's difficult to bring it to the fore. I eventually decided that the company wasn't really focused on upstream M&A. Now, only about 6 months after I left, Sam Laidlaw joined, and he decided it really was going to be an upstream company, so I wasn't very good on my crystal ball there. But I left to become CEO of this small startup business, which is listed on the Toronto Venture Exchange. And we're focused on Nigeria, Zambia, and we've also got a venture in Turkey, which are all very interesting and quite disparate sort of areas to work on. Nigeria is fascinating. 150 million people. Lagos is one of these cities that's got 15 million plus people. We were talking at lunchtime about how the Nigerians are some of the poorest, but also some of the happiest people in the world. And I think, it just goes to show that having the material wealth doesn't necessarily, impact the happiness. But it's also an absolute minefield of things to deal with. So dealing with the government, dealing with investors, dealing with human resources, all of those things, again, that I'd come across in various positions, in my companies before, have really come to the fore, and I have to deal with all of these sort of things. So I think the MBA, apart from the time management and managing on no sleep, what it did was to provide a toolkit, and I think that's really the thing that's quite important for those of you who are slogging your way through it now, and you think, will this ever come to an end? It is actually good discipline, and the toolkit doesn't necessarily allow you to do all of these things, but it allows you to ask sensible questions, and it gives you the confidence to actually be able to do that. So there's a whole lot of things that I get involved in now, which I never really would have had the confidence to do before I did the MBA. So stick with it. It's worth it. You'll get there in the end. Okay, so enough about that. What I was originally going to talk about, and I'll try and fit this in with what's been said before so we don't duplicate. I was going to set the scene a little bit, and I'll still use some of these slides because I think, although one or two of them have been shown before, I'm looking at it from a slightly different perspective, because obviously I'm coming from the upstream energy industry and how we supply particularly oil and gas, so that's perhaps a little bit different. So I'll cover a little bit about the energy mix, reserves, and prices over time, largely just to try and give you a flavour of how that impacts managing a business in the E&P sector, which everybody thinks that high oil prices are going to be fine, but actually there's some downsides to high oil prices as well. And I'll touch on the challenges. There's a lot of challenges. I've just picked out really 4 here, and they're not necessarily in this order, but I think all of them are issues that have been touched on in previous presentations and are key going forward for how the world as a whole is going to manage some of the access to the energy that we all need. So this one was shown before. It's a BP statistical review of world energy set of data, and the first few slides have all come from that, and it's a very good source of information. They publish it every year, and they've done it for 60 years now, and it picks out a whole lot of trends and information which can be used. And I think the key thing from this one really is just when you look at it from 1985 to 2010, oil, gas and coal still dominate, which I guess we've heard from the previous presentations. And even though the renewable mix and the nuclear mix are growing, they're still not an appreciable part of the mix. And I think what surprised me when I looked at this, because I've not looked at this for a few years actually, was just how much coal is coming through still, and obviously it's been driven by the Asia-Pacific region, in particular Chinese focus on need for energy and the coal in the mix. But of course, a few years ago everybody was panicking about coal. Powergen itself was trying to move out of coal. Centrica certainly didn't want to buy any coal-fired power stations. Everybody was focused on the dash for gas and using gas-fired power stations. Now they're all shut in the UK, which is itself quite interesting. This one I just thought was interesting because it comes back, it just touches on the Asia-Pacific region, the volume of coal that's being used there, and actually the relatively small proportions of oil and gas, although Japan itself has got very high LNG usage. Middle East, as you'd expect, is mainly oil and gas, and a very high proportion of hydroelectric in Central and South America. One of the presenters this morning, Morris, was talking about the decline curves associated with some of the oil fields and what's going to happen into the future and how do we predict. And he's absolutely right. One of the problems we've got is that, and I've worked in Abu Dhabi and I know how secretive some of the national oil companies and the governments are in that region about their reserves base and what the decline might look like. And it's really for political reasons, because OPEC has quotas set, and each of the countries within OPEC will be given a quota, and that quota will be determined to some extent by the size of its own indigenous reserves and what capacity it's got. And the difficulty is that nobody wants to actually admit to how fast things may or may not be declining, because it might affect their quota. But what was talked about this morning was that things could potentially decline reasonably quickly, and what would happen then. I think what's interesting here, if we look at the three decades from 1990, 2000 and 2010, these are proved oil reserves. So these are reserves that can be economically put on production at reasonable oil prices at the moment. We don't have to have any new technology to develop them. And what you can see in the centre of the ball is we started out in 1990 with about 1 trillion barrels of reserves, and in 2000 that had gone up to 1.1 trillion, and actually in 2010 we're now looking at nearly 1.4 trillion. So despite having produced 85 to 86 million barrels of oil a day, the reserves have actually increased over that period of time. 86 million barrels a day is quite an interesting one, because if you work it out, it's actually 1,000 barrels of oil a second, which is a sort of a milestone number. And 1,000 barrels, the barrel, if we look at UK measures, imperial measures, that's 35 gallons. So that's 35,000 gallons of oil a second are being used worldwide. But the reserves have increased. And I'll talk a little bit about where that's come from going forward. But I think that's interesting. We're not running out of oil at the moment, and of course there's a lot of debate about peak oil, which is another topic really. The other point just perhaps to make on this slide, and it's been touched on before, when we look at the spread of reserves, obviously the Middle East has declined proportionally, but it still dominates. More than half the reserves are in jurisdictions which are not using the reserves. So there's that geopolitical pressure for getting those reserves and accessing them. It's changed over time, partly because of the increase in reserves in places like North America, but also I think South America, there's been some very innovative technological advances which have unlocked some fairly major fields. So looking at the same thing but in gas reserves, we see exactly the same thing. 1990 we had 125 trillion cubic metres. 2000 it's grown, and 2010 it's grown again. So again, we've been producing gas through all this time, but the reserves base is actually increasing the whole time. So we're not running out of gas anytime soon either. The other interesting thing on this one is the Middle East doesn't dominate. We see much more influence of Russia and the former Soviet republics, as well as other sources of gas. One thing just to note on here is the low proportion of gas in Asia Pacific, which is one of the biggest energy users worldwide, and actually it doesn't have much in the way of indigenous reserves. And I suppose from a parochial perspective, from the company that I'm working in at the moment, Africa doesn't form a very big part of this reserves mix, either on the oil or on the gas side. And that's largely because I think governments have not really got their act together particularly well in trying to develop these reserves. There's plenty of reserves there. We know in Nigeria there's a huge amount of gas, but there's no policy in place to actually get these things on stream. So it's rather frustrating, really, when you see the potential that's there, and I think that will grow into the future, but it's not there at the moment. This is to try and give a feel for what was touched on before in one of the presentations. The reserves to production ratio is obviously just how much are you producing and how long is it going to last. What you can see here is coal reserves in the former Soviet Union. There's 450 years worth. And again, there's the mix of where you want the resources is not necessarily where it is. So, but just looking over on the right-hand side, just on the world reserves to production, we've still got 45 years of oil production at current rates, over 50 years of gas, and well over 100 years of coal. So I don't think we need to panic quite yet. This one was again touched on before, but it's quite an interesting graph, and there's a number of things that sort of come out of it. Over on the left-hand side, whale oil was the major use or the major source of lighting back in the 1850s, and there were all the whalers coming out of the northeastern United States to go and fetch different sorts of whales because they produce better light and better candles and all the rest of it. And that whole industry created when there was the discovery of oil in Pennsylvania. And I guess one of the things that's been talked about in the past by, I can't remember who it was, said that the Stone Age didn't end because the people ran out of rocks, and they were talking about the same thing to do with the oil industry. But in this particular case, the whaling industry definitely did end because of the discovery of oil. And the price was very volatile in the first few decades of the oil industry. Nobody really understood where the oil came from. That was the big problem. So they were drilling for it, but they didn't really understand what the geological environment was and how to get it back. So they'd have failures, and the price would shoot up, and then they'd find another resource, and it would come back down again. And eventually, with the growth of electric light and Thomas Edison and what have you with light bulbs, the use for petroleum actually moved into more transportation and power uses. And the price also settled down. So from sort of 1880 onwards, although we had some spikes, it was relatively flat through till about 1970. And partly, even despite the wars, and I think there's a number of reasons for that. Partly there was plenty of oil around. There were some big discoveries in various places, including the Caspian, East Texas. The East Texas field was discovered. And the other thing was that the major companies, the Shells, BPs, Exxons, Mobils, etc., were mainly vertically integrated, so the production would actually be sold on long-term contracts through to the refining end of the business and the petrochemicals end of the business. So there wasn't really very much crude out on the open market, and so price signals were really missing from this picture. During the 1970s, there was a growth in spot trading, and the long-term contract structure of the industry started to break down. And that had started to create a little bit more visibility on prices and also potentially a little bit more volatility. And then, of course, we got to 1973. There was the Arab-Israeli War, followed by the Iranian Revolution, and we saw a big spike in oil price. And that was the first supply-side shock for a long time that had hit the oil sector. And it was a great shock to everybody. I moved to Houston in the second period, about 1980, just as the oil price had rocketed. And I was working in the oil industry in Houston, and the American car industry based up in Detroit, which had been used to building huge 6-7 litre Cadillacs and Pontiacs and various other things, one of which I was driving around in, used to do gallons to the mile rather than miles to the gallon. You know, they were just horrendously energy inefficient. And the car industry just went into an absolute downturn, and everybody was moving out of Detroit. And there used to be all these bumper stickers around saying, "With the last one out of Detroit, please turn out the light." And Houston grew from 2 million people to 4 million people within 4 years while I was living there. And it was a huge boom time. But of course, what we didn't realise was that it wasn't going to last. And the price actually collapsed in about 1984, 1985. And that gave everybody a little bit of a short, sharp shock, because the industry had been recruiting very heavily and all of a sudden had a plethora of people and not really any visible ways of making profit out of the business, which for the last 5 years they thought was going to be a fantastic place to be. This volatility continued through until about 2004, and I'll go into a little bit more detail a little bit later on, but we can see that we've got this current spike, and the crude Brent was trading at about 127 yesterday, and I noticed in the press that Vitol was talking about $150 as being a forecast for the end of this year. And one of the banks was actually saying that it could well go to $200. Now, given what I've shown on the reserves and the fact that there's plenty of capacity and reserves in place, it's quite interesting that that's still happening. And I'll touch a little bit on what may be the causes behind that. Just to sort of round out the picture, I suppose, selected gas prices. A couple of things really to note on this, I suppose. One is relatively flat through till about 2004, and then everything started to become really quite divergent. Henry Hub, which is the US Louisiana gas pricing point, has climbed up to a peak in about 2008 and has subsequently just fallen and is continuing to bumble along. And as was mentioned before, it was trading, I think, at about 250 yesterday per million BTU. Now, given that we were looking at $6, $5 to $6 only a few years ago, that makes planning for what you're going to do in the upstream sector and what you're going to invest in really quite difficult. In contrast, the Japanese LNG continues to go up, and that's because in the main, the Japanese purchases of LNG have been linked to a basket which includes oil prices. So as oil prices go up, the LNG prices go up. So there's still potential to make a return from LNG, but I'll touch on what has happened with the shale gas discoveries in the US and how that's provided its own challenges. Natural gas trade. I think the main thing from this slide is just a huge pipeline trade in Europe, and a lot of that is driven by Russian gas coming into through Germany, through some of the hubs, and also Norwegian gas, and huge volumes. There's a big network of infrastructure in place. Similarly in North America, but a much smaller volume of trade, despite having a big pipeline network. In LNG, it's driven by the Asia-Pacific region, and in particular by the Japanese. And LNG is still quite a small proportion of the overall gas market. This one is quite interesting, I think. And again, this data here is taken from the US EIA. What it shows is that overall gas production, I've tried to put these on the same basis, so it's barrels of oil equivalent, so that you can see how gas usage compares to oil. And gas usage is significantly less than oil. And there's a number of reasons for that, and to a large extent it's because gas is just much more difficult to transport unless you have a transport network in place, and also the variety of uses that you can put crude oil to, in particular, in the petrochemicals side. The other thing just to note is that in about 2007, world oil consumption actually started to drop. Didn't last very long in a world basis, but just for that period of time from 2007 on to 2009, it actually started to drop, and it looked as though efficiency measures which were being driven by European governments and North American governments in particular in terms of motor efficiency for car was actually starting to pay dividends, and so we could see this very slight downturn. Now that didn't get the oil industry into a panic because it wasn't enough of a downturn to really hit. But it's interesting because when you look at the prices continue to go up, even though the the consumption was actually going down. The reason the reason the oil price has gone up very quickly was really Chinese and Indian demand. From 2004 to 2008, Chinese GDP grew by 11.6%. Compound, and Indian growth was about 8%. So there's a huge demand growth. So compared to the supply side shocks that we'd had in 1973 and 1979, we were looking at the demand side shock here. But what you see is that the price actually peaked into 2008 after the oil price, the oil consumption had actually started to drop. And again, it's difficult to unpick exactly what was happening there, but it looks as though with the increased level of futures and paper trading, actually there was an overshoot as speculators had got into the market. Everybody's panicking about quite what was going to happen with supply and demand, and people had traded, in fact physical crude is often traded tens of times on the paper markets. One physical barrel will have a number of trades behind it, and it looks as though that was probably what was actually happening. And then of course we hit the worldwide credit crunch. Now, from my perspective, I was sitting here in my little startup and I was trying to convince investors that the oil industry and the Nigerian oil industry was a good place to put money. And of course, when I was sitting there in 2007, we just picked up a new venture. And the oil price was steadily going upwards, and I could show that the project looked robust at about $50 a barrel, and here we were at $60, then $70. People could overlook some of the issues which were happening in Nigeria at the time, which is militancy down in the Niger Delta, which is the main area of production, as people felt disenfranchised by the government, didn't feel they were getting the right share of the spoils. So every time I went to meet investors, it always seemed to be that CNN had a picture of a Nigerian militant with a bandolier of cartridges over his shoulder and threatening to shoot people, and I was trying to tell them this is a great place to put their money. But the rapid build-up in the oil price, of course, tended to sort of mask all of those issues, so people were still happy to invest. And then all of a sudden, 2008, Lehman Brothers, I was just in the process of raising 20 million to drill a well, and Lehman Brothers, I got most of the financing not actually in the bank, but people had promised it. And then everybody started ringing me up and saying, well, Tony, we're really sorry, but you've seen what's happening in the market. We can't give you the money now. So, we were down at $40 a barrel, and of course that was below where my project looked as if it was going to make some money. So this volatility is a really big issue, and trying to manage through that is very difficult. And in fact, what we had to do was to sell down a proportion of the project. And the company that's now reversing into us is actually the company that I'd sold down some of the project to. And of course now we're seeing the price going back up again, ironically. The other thing on this particular slide is here we're looking at Henry Hub gas prices again. And you can see that gas prices and oil prices are actually tracking broadly through till about 2003, 2004. And all of a sudden things start to diverge. And I think what we're seeing there is an influence of the increase of spot trading. Previously, some of the gas contracts were also on long-term bases. And the particular drivers for oil demand in China. And what we see now, of course, is the gas prices on the Henry Hub dropping down from a peak of, on an equivalent basis, oil equivalent basis of $70 down to below $20. So it's been a huge fall. And in terms of investment in North America, that of course really impacts what you're going to plan for. So challenges, given all of those things. I've listed these four here: access, technology, economics, and finance and human resources. So what do I mean by access? Well, access includes a number of things, but I suppose really access to new areas to try and find new reserves of oil and gas. One of the problems with the industry and the geopolitical tensions, Iran has got a lot of oil reserves, but of course Iran is at the moment suffering embargoes. It's not a place that the Western industry can get into and the OECD industry can get into. And so some of those reserves are not really necessarily going to be accessible. The industry had started to move into other areas, and that was really what was behind the push into deep water. And we saw the issues with Macondo a couple of years ago. But deep water has been a challenging area. There's a whole lot of new areas that have opened up. There's been a lot of discoveries on the east coast of Africa around Mozambique. That was an area that opened up a few years ago. And in the offshore Brazil area, there's some very interesting discoveries that have been made there. The big problem is that these things, even though they're big, are still not on the scale of the sort of fields that we see in the Middle East. And Ghawar in Saudi Arabia, which is the world's biggest oil field, has been producing for 60 years and is still the world's biggest single producer of oil. And it's very difficult to replace those sorts of fields. But all of these things that I refer to here have been talked about in the press this last week. So these are all very current. On Monday it was reported in the press that ExxonMobil had been barred from picking up any licenses in Iraq because they'd signed some agreements with Kurdistan. Now, Kurdistan is actually part of Iraq, but the Kurdish government has actually got their act together more quickly than the Iraqi government and has some policies and frameworks in place for oil exploration, oil and gas exploration. And ExxonMobil have signed something up. So, of course, the Iraqi government's now quite upset. So they're now barring ExxonMobil from getting into Iraq. Now, there's a whole lot of issues that go on behind that, but it's quite interesting because that means there's an area for the world's biggest oil company that's not actually accessible. I've talked about the Iran embargo. I mean, in many ways, the sort of limited impact that's going to have on France and the UK from Iran deciding it's not going to sell us any crude oil. It's really just a political statement more than anything else, but these sort of things can spread. One of the things that was talked about this morning was drilling for shale gas and the Central European potential. It was announced on Tuesday that Bulgaria had decided to ban drilling for shale gas. And it's deemed to have potential for significant reserves of shale gas. And the issue there is that there's a concern over the environmental impact of the fracking, the hydraulic fracking, to get the gas out of the ground in the first place. So they banned it. Now, that's the second country to do it. Is that going to spread? And is that going to have an impact on the potential for shale gas to be a resource into the future? Along the same lines, the US, which is supposed to be one of the most sort of friendly countries for oil and gas companies, and there's always criticism of the way they pander to the lobbies. Drilling offshore Florida has been banned for a number of years, and finally the US House got round to passing a bill to allow new drilling offshore Florida, but apparently everybody believes the Senate will not pass this. So there's a big chunk of the US that is actually off limits, so issues with access there as well. Civil unrest, we've heard about the Arab Spring, obviously the impact in Libya and Syria of the ongoing unrest there means that those areas are going to take some time before they can be opened up again. Indigenization pressures, I mentioned Nigeria here because it's just something that I've got personal experience of. Quite often what happens in developing economies is they want to ensure that they're developing the capacity and the expertise to develop some of these technologies and business models themselves. So what's happening in Nigeria is there is encouragement for the Nigerians themselves to set up companies and to take licenses, and it's creating difficulties for companies from outside Nigeria to actually access some of these areas, and Nigeria has huge potential for oil and gas. So that's just one example where this indigenisation could cause problems. And then we've talked about the changing role of NOCs, and that was touched on before. And we can see the increase in spread of these companies and the technology and financial firepower that they have now. Technology, I suppose, coming from a technological background or a technical background, this is something that's quite near to my heart. I think two things can happen here. I mean, we've heard about the impact of technology on energy efficiency and what happens on the demand side. When we look on the supply side, there's a number of things that have been happening over the past few years that have really made a difference. Three-dimensional seismic technology and attribute analysis. Now, 3D seismic's been around for some time, but it's been one of these technologies that is incredibly computer intensive. It's one of these things where the biggest users of computing power worldwide used to be the US missile defense system and geophysics for 3D seismic. More efficient processors and work on the mathematics behind some of these things has really improved the technology. And in fact, the 3D seismic, I talked a little bit further down about the deep water drilling offshore Brazil. One of the things that's unlocked that whole area is the 3D seismic and the processing that's gone into the seismic, so you can actually image the geology below this deep salt, which wasn't possible before. It just looked like a complete mishmash of data. So that has made a big difference in terms of reducing the risks when you're drilling a well. Now, the Tupi well offshore Brazil cost $250 million. Now that's set some sort of world record, I think. But there's a lot of wells that still cost tens of millions of dollars, and the recovery, the chances of success are generally about 1 in 5, and in some of these frontier basins it's worse than that. So if you can reduce the risks on those things by improving the technology, that's a huge benefit, and this 3D seismic has really helped. The attribute analysis in conventional reservoirs, sandstone and limestone reservoirs, you can actually directly pick up signals of oil and gas. Now, people have been playing with this for years. When I was doing sort of seismic analysis, we used to look at it, but the chances of that actually being correct a lot of the time were quite low. But now it's really improved, and in some cases it's improving the chance of success to about 80% when you're looking at the seismic and trying to predict what's actually in the subsurface in certain areas. I've put in here long reach and horizontal drilling. One of the things that was fascinating in BP, and I was responsible for the subsurface of it for a time, was Witch Farm. Witch Farm's an area of outstanding natural beauty down on the south coast of England, and drilling was banned except for one drill pad. So to get to the reservoirs, the bottom of the wellbore was in some cases nearly 20 miles away. So if you can imagine trying to thread a straw down through the ground under the water and go and find something which you've mapped on seismic, which is 20 miles away, with a bit that's only that big, that's fantastic technology, and it enabled those reservoirs to be tapped, which otherwise they would never have been allowed to do. Horizontal drilling has improved recovery factors as well, and those things have fed into the fracking for shale gas. Now, the shale gas, it was presented this morning, huge reserves, potential panacea in the US. It's very interesting, actually. One of the problems with the shale gas is that you can't actually use some of the conventional technologies to find where the sweet spot is. So with seismic, you don't really see where the best reservoir properties are. And so the reason that thousands of wells have been drilled in North America is because a lot of them have found really that they can't actually extract any gas at an economic rate. And it isn't until you find a sweet spot that really changes. So it's a completely different process to the normal upstream process, which relies on geology, geophysics, and then petroleum engineering. This is all about a factory process, putting as many wells down as you can and finding the sweet spot. Now, that creates its own issues in the States. In a lot of these sort of Midwest states where there's not many people around, drilling that density of wells isn't a big issue. That's not going to be the same in Europe, where the population density is higher, and not everybody wants a drilling rig sitting in their back garden. So I think the jury's still out on quite how that's going to develop. And the other interesting thing, I think, and I'll talk about it in a minute, the reserves associated with the shale gas. In some cases, I've seen reports of well over 1,000 TCF in North America, and then the US Geological Survey have come in with something that's about 25% of that. So nobody really knows, because it really comes down to finding these sweet spots and getting the economics to work in the right way. I've talked about this deep water project offshore Brazil, subsalt, which has been a fantastic success, but $250 million for a well, that makes the economics very, very challenging. And the other thing about working in deep water, as we saw with the BP issues on Macondo, is how do you manage the risks in those sort of deep water environments if something goes wrong. Final point on this slide is I've talked about exploration and finding all these new reserves. Actually, a lot of those reserves additions that I talked about on the first slides have come from additions to existing fields, finding new areas, new reservoirs, and actually improving the recovery factor. The recovery factor in most cases for oil is probably only about 30%, so 70% of the oil stays in the reservoir. So improving the recovery technology and using secondary and tertiary recovery, chemicals to try and break down the surface tension and get more of the oil out can have a huge effect. And if you've got a huge field, 10% increase in recovery factor can easily match a new discovery from somewhere else. And in fact, a lot of those improvements that we've been seeing have actually been these additions and improvements. Economics, well, as I said before, everybody thinks that high oil price is a panacea if you're in the producing business. The problem here is that, for example, the Chinese demand growth, it led to cost-based pressures. Between 2004 and 2008, on average, the unit cost of developing an oil field doubled. And that was because there was so much pressure on pulling in steel to China that the steel that was going to be used in the wells had actually been used somewhere else. Services costs were going up as well. So a lot of your increased revenue and rent disappears because of the increased cost base. And the other thing is, despite countries like the UK supposedly having a stable tax regime, as soon as governments see high oil prices, they always see that as an easy target for adding on new taxes. So that has hit the UK quite heavily. Gas economics, the shale gas discoveries, as we were talking about Barnett Back and Marcellus and all those sort of things, there's been a huge amount of work in finding these things. Now they've found them, the gas price has collapsed. So you haven't got any benefit of having done all that work, because now the operators aren't being remunerated for all that work that they've done in developing the reserves. The other thing that's happened, and when I was in Centrica, we were looking at the US as a potential LNG export target. And we were focused on a project in Nigeria at the time, and a number of other countries were as well. And the idea was to build liquefaction trains, send it across to the US. But you need about $6 plus MMBTU to make this work. And of course now the gas price has collapsed. So having built all these regas terminals for importing LNG, now the US is talking about building liquefaction trains to export it. So within a period of 5 years, we've gone from one model, which is of import, to a completely different model of export. And so planning for one of these projects, which might take 10 years to actually really get running and takes huge capital investment, is very, very difficult because of this volatility. So volatility is a problem in the economics. I've already talked about investor uncertainty and people saying, we're very keen to invest. Whoops, the price has gone back down again. How does that hit you? The other thing that's happened in the industry on the upstream side at the moment is staff. And here I'm talking about technical staff, geologists, geophysicists, petroleum engineers. A lot of companies laid off a lot of these people when they went through low oil prices, so back in the 90s and then back in the early 2000s. So there's now a huge gap in the experience base within the big companies to actually take advantage of some of the things that are going on at the moment. And a lot of university departments closed as well, so it's caused a problem. So I think there are a lot of challenges in developing and delivering a secure supply of oil and gas from the upstream perspective. But I think the interesting thing is that over the past 25 years, in this period of unprecedented price volatility, the industry has adapted and still managed to deliver. I don't think it's necessarily sold its message very well to the public. But the other thing I think is going to happen is that we're going to have to continue to manage that, because over the next 25 years things will still continue to be volatile. But I don't see it going away, and I don't see oil and gas going away as part of the energy mix going forward. I don't see, we talked about magic bullets, and I don't see a magic bullet. I think there might be a whole series of complementary small changes that will change demand and change supply. But I think we're in a sort of, what we're in now will continue for some considerable period. Anyway, thanks very much for listening. I don't want to keep you from the drinks reception any longer. So thank you.